Hello and welcome to Moneylife. This is Sucheta Dalal. When the market is falling, what are we going to talk about? Obviously, fake gurus, risky bets, and the big question that all of you have, can regulators do a little more to allow investors to make the right choices? I know that when stocks fall, we like to blame the regulator. This time it's going to be no different when small caps are crashing. But let's look at how things work in a raging bull market. So for this, let's go back in time, really far back, nearly 100 years, 1929. So legend has it that Joseph Kennedy, the very smart market player, was offered stock tips by a shoe shine boy. This led him to sell all his holdings in October 1929, just before the big crash that was followed by the Great Depression. Kennedy, as some of you may know or may not know, went on to become the first chairman of the US Securities and Exchange Commission and set the tone for that regulatory body. Now, come 100 years later, almost 2024, and what do you have? Nifty King Abhay Gandhi. Look at this image, it's showing it to you. He actually sent out this color pamphlet to SEBI registered investment advisors. And what does it say? Not only is he offering you stock tips and training and all that, but he boasts that he had done a 500 crore scam and spent 6 years in jail. This is the world we live in today, where a scamster is a hero and someone who spent 6 years in jail having self-claimed done a 500 crore scam is the man who's sending out pamphlets and offering training. In fact, let me read out exactly what he says, and we're showing you on the screen without editing his English. In 2001, I was involved in 500 crore scam at Ahmedabad city. After releasing on bail in 2017, I researched on Nifty call, put buying strategy for 7 years, and I got perfect intraday trading strategy. Unedited quote. So he's offering a 30-day stock trading course. He's going to help you earn, guess how much? 10 crores every month. And it's another matter that the self-proclaimed expert is a little confused between lakhs and crores, because on the pamphlet that he sent us, he says his fee is 25 crore. So I was so taken aback. We checked his website, fearlesstrade.com, where it's a more modest 25 lakhs. What is 10 here and there when you're making 10 crores a month, right? So Fearless Gandhi not only sends out pamphlets, he has YouTube videos, he has Twitter account, he's openly putting out his contact number. Forget about SEBI registration and compliances and rules like that. It doesn't concern him. And he may be finding people as well. Is he an aberration? Is he an exception? Well, take a look at this. Maheshwar Perry, an educationist, publisher, activist, has done a lot in education, tweeted this just recently. I'll show you the tweet. He says, this influencer, Elvish Yadav, many of you may be following Elvish Yadav, recommended a stock at 135, which is now trading at 7.55. 94% loss. He has 16 million followers. He promotes gambling. He faces allegations of supplying snake venom, using minor girls, threats, bullying, whatever. He now wears a Rudraksha to protect himself. I don't know whether he's being protected from his investments and does he follow what he preaches, but he has 16 million followers. The regulator has perhaps not noticed him as yet, or is slowly investigating it and may take action sometime in the future. After all, he's an influencer and he's giving stock tips. None of this would be free, right? We are doing it on behalf of someone, and this does not come under SEBI regulation at all. Now, if you're wondering whether investors fall for this, think again. You just have to open your daily newspaper. If you look at it carefully, every single day you will have 1 or 2 reports about people who have lost money because they have fallen for trading apps, people like Mr. Gandhi, or listen to Elvish Yadav's tips. In fact, there are apps, trading apps, which are completely fake. How bad is this? India ranks 3rd as a source of malicious social media scams, and they are growing exponentially year on year, over 150%. So much so that the Indian Computer Emergency Response Team, CERTIN, issued a recent warning about fake trading apps. Now, the problem is that those who trade, those who have come recently into the market by the millions, don't read any of this. They are busy only looking at social media and stock tips. So they miss these warnings. What does this warning say? That fake trading apps are enticing people through social media with the promise of substantial earnings. They demonstrate this to manipulated images about their performance. Now, the Mumbai police alone registered 11 cases in the last 1 month, and the amount lost was 4.4 crores. It's a big sum for me, hopefully a big sum for you too. The modus operandi is consistent and similar. Investors download the app, they buy and sell shares. These shares seem to be reflecting, and the profits seem to be reflecting on this app. It's displayed online, but when they try to encash it, when they try to withdraw the money, they realize they can't, and they know they're swindled, and they rush to the police. So it's often said, a fool and his money is easily parted. And it is the regulator's job to prevent this happening. Can the regulator do it? It's unfair to have these expectations. The onus is on us to be careful. And to their credit, this time around, the Reserve Bank of India and the Securities and Exchange Board of India have issued multiple warnings, have initiated action to curb excess leverage, have warned about the froth in small and medium enterprise stocks. You've seen the results. They have cracked down on dubious funding strategies. All this has been mentioned just this week by Debashish Basu, editor of Moneylife, in his column as well as his video blog. Now, it is up to us as investors to be more vigilant. We have to engage with SEBI and RBI registered entities if you want to be careful, not influencers that you meet on social media. We have to do our due diligence before investing. But I would argue that if you are a novice, if you are a stranger to capital markets, you want to start trading, where do you get to know about these registered intermediaries? And how would you know who's good and who's not? What do you know about their performance, their background? Where do you find them? On the other hand, you find all the fake ones all the time. Just open a YouTube channel. Even before you started watching this video, you would see a couple of ads fed by Google and fed by the large multinationals to you, which are offering training courses, stock trading. They are everywhere. They have the funding because the ads are funded. While those who are doing genuine advisory work, who are regulated by SEBI, face such stringent compliance requirements, advertisement restrictions that are so rigid that these intermediaries can barely showcase their work and definitely not advertise it. There is no revenue for it. So they can't make their presence felt, unlike the influencers and all these fake pundits and gurus and self-proclaimed scamsters who are saying you can make 10 crore. Performance metrics of SEBI-registered portfolio managers and fund managers not only have to be audited, as you know, but have to be validated by a third-party agency before any claims can be made. The influencer, on the other hand, just takes a snapshot, doctored, edited, uses AI, and claims something which is believable because investors don't know that others exist, right? So they use Facebook tweets, Instagram, LinkedIn, recommend specific stocks, make false claims. They vanish when something is lost. They use artificial intelligence to misuse the names of trading gurus like Rakesh, the late Rakesh Jhunjhunwala. They have created fake videos which include, these are even Ponzi schemes and MLMs. They have used names of Ratan Tata, Mukesh Ambani, Nandan Nilekani, Narayan Murthy, Azim Premji. Each one of these has put out disclaimers and said, sorry, this is fake and fraudulent. Our names are being misused. But do people care? Even last week, someone called me to say, what do you think of this scheme promoted by Mr. Nilekani and Narayan Murthy? Offering huge returns. So it is happening every day because the fakes are visible all over and the genuine ones are under such a straitjacket of restrictions and compliances that they cannot even tell you that we exist unless it's word of mouth and you happen to know someone or you go to the website. In a raging bull market like the one we have experienced since 2020, the law of probability favors these frauds because how many will SEBI catch? The numbers are so huge. Those who are punished are so few that it's not a deterrent. Meanwhile, if you want to go to a registered portfolio manager, you have to have a minimum of 50 lakhs because that is the threshold that SEBI has pegged. So they can't get, so you want expert advice, but if you don't have a kitty of 50 lakhs, you can't go to them. So what happens? You then look at an alternative. SEBI, in fact, has an alternative that is allowed without regulation. Free, zero cost, zero accountability. Who are they? Your friendly neighborhood relationship manager. This RM is in touch with you. He knows you have money in the bank. He's persuading you to make investments. He is going to introduce you to SIPs. What does he recommend? Any mutual fund that is selected at the corporate level by his bank. He will ask you to open a trading account, a demat account, a 3-in-1 account. Then they start giving you stock tips. They offer you training. They connect you to brokers who will offer the training. Then they offer you leverage and say you can multiply your money by making a borrowing pledge or have a lien on your existing FDs and investments. You don't need to break them, but you can leverage and multiply your income on the stock market. Look at how the bull market is raging and you end up falling for it. And all this is free. So when you have this free, why will you pay an investment advisor who is not even advertising himself and his performance? So I do believe that the regulators have a role in actually hiding the better people from public sight while being able to do nothing about the fakes and charlatans, right? RMs have no investment qualification. What is worse is the banks themselves have no responsibility for what they have recommended. This includes private equity clients. They have a form, they fill it in, they get you to agree. So once you have agreed, that's the end of their responsibility. You are supposed to have done due diligence. It's understood that you have looked at it and then signed off on this form. The RMs are very diligent about taking these forms, and you can have a bad investment, you can lose crores of rupees, you can complain. They are willing to fight you in court because they know that once you've signed that form with no responsibility, so no validation for what they recommended throughout the year. SEBI does not ask banks because banks are not under SEBI regulation, and they get away with it all the time. It's not just banks, non-banking finance companies are helping people with leverage. RBI is cracking down on some of it. Bank officials who are doing all of this are not even qualified. No NISM certification for any of them. They have a job with the bank. They sell what the bank asks them to. Bank is not responsible. RM is not responsible. This time around, RBI has proactively discovered that brokerage firms linked to banks are offering leverage and cracking down on it. But like I said, it's at the end of 4 years of a bull run. It is rather late and very small in terms of the quantum that is happening. Let's talk about the regulator's responsibility. This issue of financial influencers luring gullible investors is not an Indian phenomenon. It is a global worry. Regulators around the world are concerned. In December 2023, the International Organization of Securities Commissions, in fact, issued a warning, giving you a link there. It calls it very mildly online harm. What is online harm? It is financial fraud that, according to IOSCO itself, and I'm quoting, primarily targets retail investors in securities and derivatives markets using deceptive acts or misleading fraudulent content, including user-generated content. This takes the form of advertisements, videos, impersonator websites, social media posts, comments, and reviews. Yes, comments and reviews are also fake. I made a great profit, so-and-so is a fantastic expert, may be all wrong. The person who's saying it may have just been paid for that review. Then all this is magnified using artificial intelligence tools. This is a two-way street because while scamsters use it, actually regulators can also use AI to catch people faster. Not yet happening. Everyone's working on it, but it's a possibility. It all takes time. Even using AI effectively, going after people, punishing them quickly takes time. So the solution is with us. Better vigilance from investors. Be wary about unsolicited advice. Do your due diligence. Watch out for promises of guaranteed returns that seem too good to be true. Now, regulators seem to think that the solution is simple: bombard you with investor education. So every intermediary, bank, the National Payments Corporation, everybody, including RBI and SEBI, are bombarding you with ads, warnings. The cyber police are doing it. Do you read? After it becomes excessive, the effectiveness of this tactic and strategy is diminished because people stop looking at it. A better alternative, to my mind, would be to publish data on the best and worst performing funds, portfolios under different categories. SEBI has a website. SEBI used to publish, when it started in 92, a list of companies which had the maximum investor complaints. So why not just put this out without any comment? Validated performance is put out. If it is, it will be used by people. The media will use it. Social media, the diligent people will put it out in the public domain. Those who do good work and perform will become more visible because it will have a virality of its own without SEBI doing anything other than issuing a release. SEBI and RBI need to do it because they need to help people track authentic data and make the right decision. It's not enough just to bombard them with generic, bland ads which say, be careful, watch out, look for things. It doesn't help. Instead, give visibility to people who perform. You don't need to comment. You don't need to recommend. You just put out validated data. The bull run is likely to continue. This is still a requirement because people lose money. You can call them foolish, but it is the regulator's job to be concerned. If you agree, please amplify this, subscribe to it, and make sure that the regulator listens to our voice. Thank you.